You don't need to be a genius to invest well, but you do need to have patience and the right mindset. This quote from Warren Buffett, one of the most successful investors in history, is the starting point for our topic today. Have you ever wondered what it would be like to have complete control over your financial future? Or how people like Buffett manage to build immense fortunes even in times of economic uncertainty? The answer lies in the timeless principles he follows. And the best part is that you don't need to be a billionaire to apply them. In this video, we will explore 5 essential principles from Warren Buffett that can transform your perspective on money, investments, and even life. It doesn't matter if you're just starting your financial journey or already have experience. These lessons are for everyone. Get ready to understand why patience can be your greatest asset, how crises hide opportunities, and how to think like a true owner, whether of a stock, a business, or even your own dreams. And an important warning: this is not just another quick fix content that promises overnight wealth. What you're going to learn here is a strategy to build something lasting, just like Buffett did. So stay with me until the end, because each of these 5 principles could be the missing step for you to transform your relationship with money and, who knows, pave your own path to financial success. The first major principle is investing for the long term. Warren Buffett believes that the financial market rewards patience. He often compares investing in stocks to planting a tree. Significant returns come with time. Buffett advises focusing on sustainable growth and long-term appreciation instead of chasing quick and speculative profits. When Buffett bought Coca-Cola shares in the late 1980s, many investors believed its appreciation would be limited. However, he saw the company's intrinsic value, its brand strength, and the consistency of its profits. Today, decades later, his investment has yielded extraordinary multiples. Long-term investing is not just about time, but also about consistency and vision. Many people are drawn to quick gains, but Buffett emphasizes that the stock market is a device for transferring money from the impatient to the patient. The most important thing is to set clear and long-term financial goals. Use automatic investments such as monthly stock or ETF purchase plans to avoid impulsive decisions. Avoid constantly checking the market's daily performance. Buffett rarely worries about short-term fluctuations. Now imagine a 25-year-old who invests 300 reais per month in a fund that yields an average of 8% per year. By the time they turn 65, they will have accumulated over 1 million reais, even without ever increasing the monthly amount. This is the magic of the long-term and compound interest. The second principle is that you should buy businesses, not just stocks. Buffett emphasizes that investing in a stock is the same as investing in a company. He analyzes the business's performance, fundamentals, and management before buying its shares. His motto is, buy stock in a company as if you were buying the whole business. Buffett bought Burlington Northern Santa Fe, BNSF, an American railroad company, because he recognized its strategic importance in the economy. He didn't just purchase shares, he invested in a company he considered essential and well-managed. To invest like Buffett, it is essential to see beyond the numbers. Every stock represents a fraction of a real company. The key question he always asks is, would I buy this entire company if I could? Before investing, thoroughly investigate the company, its business model, leadership, competition, and financial history. Avoid being seduced by rising stocks without clear fundamentals. Prioritize companies with strong brands, durable competitive advantages, and good governance practices. Think about it this way. If you were to invest in Amazon, consider questions like, does the company have visionary leadership? Are its revenues sustainable in the long term? Are there real competitive threats that could jeopardize its future? The third principle is to maintain a broad circle of competence. Buffett emphasizes that every investor should have a deep understanding of their circle of competence, meaning the set of sectors or companies they have solid knowledge about. Investing outside this circle increases risks and lowers the chances of success. He never invests in sectors he doesn't fully understand, such as technology companies in the 1990s. His focus has always been on predictable industries like food, insurance, and retail. Buffett often mentions that he doesn't need to know everything, only enough within his circle of competence. He advises investors to be honest with themselves about what they know and to avoid speculating in unfamiliar areas. List sectors or businesses you understand deeply, whether through professional experience or personal interest. Limit your investments to these areas. For example, if you work in healthcare, study companies in that sector. Gradually expand your knowledge, but without rushing to master every market. If you don't feel confident analyzing individual companies, consider funds based on broad indexes. This is a strategy that Buffett himself recommends for less experienced investors. The fourth principle is to value the margin of safety. One of the core concepts of Buffett's method is buying assets for less than they are truly worth. This practice, known as the margin of safety, protects investors from miscalculations and unexpected market fluctuations. Buffett bought shares of American Express during a financial scandal in the 1960s. While other investors fled, he recognized that the company's real value remained intact and purchased shares at discounted prices. No one can predict the future with absolute precision. That's why Buffett insists on always buying stocks or businesses with a margin of safety. This means paying less than the company's estimated intrinsic value. Use simple metrics, such as the price-to-earnings ratio and the price-to-book ratio, to assess whether a stock is undervalued. Prioritize companies with controlled debt and consistent cash flow. Wait for the right moment to invest. Economic crises and market downturns often present the best opportunities. In 2008, Buffett bought shares of Bank of America at a time when confidence in the banking sector was shaken. He secured a significant stake at a price far below the company's real value, generating impressive returns. The fifth principle is to be fearful when others are greedy, and greedy when others are fearful. One of Buffett's most famous maxims encourages investors to go against the crowd. He believes the best opportunities arise during times of panic when the market offers great deals at discounted prices. During the 2008 crisis, Buffett made substantial investments in solid companies like Goldman Sachs and General Electric. He took advantage of low prices while others were afraid to put money into the market. Be greedy when others are fearful is easier said than done. Moments of panic often present great opportunities, but require courage and a clear understanding of companies' intrinsic value. Create a list of solid companies you would like to own. Be prepared to invest in them during market downturns. Maintain an emergency fund and available capital to seize these opportunities. Adopt a long-term perspective to overcome the fear of crises. During the pandemic crisis in 2020, many companies experienced sharp declines in their stock prices. Patient and well-informed investors took advantage of these drops to buy resilient companies at low prices, such as major retailers and technology firms. These 5 principles from Warren Buffett are simple but require discipline and consistency to follow. Focusing on solid fundamentals, patience, and a long-term vision is what separates successful investors from speculators. Warren Buffett's wisdom goes beyond numbers and charts. His teachings are life lessons that invite us to think strategically, act with discipline, and cultivate patience in a world that values haste and shortcuts. Applying Buffett's 5 principles could be the difference between achieving financial stability and continuing to struggle with the ups and downs of economic life. Warren Buffett reminds us that success is not the result of luck, but of smart decisions repeated over time. Someone is sitting in the shade today because someone planted a tree a long time ago. The question you should ask yourself now is, what tree are you planting for your future? If you enjoyed these lessons and want to learn more about achieving financial success inspired by great investors, don't forget to like this video and subscribe to the channel. That way, you won't miss any content that can transform your perspective on finance and investments. Thank you very much for watching, and see you in the next video.